In this Money Talk video, I'll discuss why you may not always want to pay off loans early, and we're starting right now. Hey guys, Elliot here. So I'd like to address a financial topic that you don't hear too much about. And it has to do with paying off your loans early if you have the means to do so. Now on the face of it, seems like a great idea, right? You've saved up, or maybe you've come into some money. So why not pay off that credit card, car, student loan, or maybe even the mortgage? Well, sometimes this is a smart move, and sometimes it's not. Let's take a closer look as to why. As always, if you enjoyed this video and find it useful, please do consider subscribing to the channel. Helps me out a lot, and don't forget to smash that like button. So what kind of debt do most people typically have? It's usually mortgage, a car loan, perhaps student loans, and credit cards. Sometimes people may also have medical debt or even tax debt, but for our purposes we'll stick to the big four, and that is mortgage, auto, student, and credit card. Now what do people do with this debt? Well, they make monthly payments and pay it down. Conventional financial wisdom states that if you have some extra money coming in and suddenly have the means to pay off a debt, you should immediately do so, so now you have one less monthly payment to worry about. Well, this type of thinking is not inherently wrong, but it's not always right either, and that's because of the ultra low interest rate environment we're in right now. You have the potential to earn far more with that money by placing it elsewhere as compared to the interest rate you're paying out, and that is called interest rate arbitrage. Also, you have to consider the legal and tax benefits of keeping certain debt on your books. Let's review the details by taking the big four one at a time, starting with the biggest one of all, which is your mortgage. Let's say you have a house that you purchased, and after a few years of paying it off, you now owe about $300,000 on it. Let's now say hypothetically you came into some money through an inheritance, and you suddenly have the exact amount needed to completely pay off the mortgage. It's tempting to do so, but should you? Well, here's what you should consider. The first is the interest rate arbitrage I was referring to earlier. If you invest the $300,000 in the S&P 500, you are statistically likely to get a 10% return on your money, as historically that's what the index has been averaging. If your mortgage rate is at 4%, you will do better by investing this cash as opposed to retiring the mortgage. There's something else to consider as well, and that is the federal mortgage interest tax deduction, which you will no longer have, of course, if the mortgage is paid off. For real estate investors, you have a few more reasons not to pay off that mortgage early, and it has to do with equity and asset protection. If you own your investment property free and clear, that means you have 100% equity in it. And this in turn means that you could be a good target for a lawsuit where you could potentially lose your property if a judgment goes against you. If you're still paying off the mortgage, that means the bank owns some or most of the remaining equity, and this diminishes your chances of being a potential target of a lawsuit, as your investment is mostly bank owned and they have the priority lien. For this reason, as well as the tax write-offs, many real estate investors, even wealthy ones with plenty of cash on hand, do not in fact pay off their investment properties early. Now, having said that, there are some valid reasons to get rid of a mortgage early, not the least of which is the peace of mind you get from owning your home free and clear. But from a financial, legal, and tax point of view, it's really not that clear-cut, and you really have to weigh all the pros and cons that I just covered. Okay, let's now move on from mortgages to auto loans. Here, the same principles of interest rate arbitrage and asset protection apply. Auto loans are very competitive, and if you have excellent credit, chances are you got your auto loan at a very good rate, paying somewhere between 2.5% and 4.5% interest in most cases. If you have enough cash on hand to pay off your car, you can definitely get a better return by putting that money into equities investing and continuing to just make your car payments. If you have an expensive car and you work in a profession where lawsuits are a high risk, a paid-off vehicle can actually be a liability and can be repossessed to satisfy a judgment. So from an asset protection point of view, it's actually best to not pay off the vehicle or even just lease it, so you still get beneficial use while it still belongs to the bank and judgments can't really touch it. Now, of course, there are some valid reasons to pay off the car as well. One that I like a lot is the ability to cancel cancel collision insurance and save quite a bit of money every month. You are still of course required to carry liability insurance, but collision coverage is optional once you pay off your vehicle and the lien is removed. So the bottom line is you gotta weigh all your pros and cons carefully, and if you're an active investor, it just may make more sense to invest your money in the market and continue to make monthly payments on your vehicle and not pay it off right away. Next, let's jump to student loans, which are unfortunately a fact of life for a lot of college graduates these days. Now I'm going to mostly address private loans here, as publicly funded loans have a lot of forgiveness and forbearance options that have been legislated in recent years, and you should take advantage of them if you qualify. With private loans, you don't really have these perks, but fortunately the interest rate is relatively reasonable, with my personal college loans averaging about 3 to 4%. Here you don't have any asset protection concerns, and it's purely a question of interest rate arbitrage, as you can, again, earn a lot more in the equities markets. There are also some interest rate tax deductions that are available, but the student loan ones are not as significant as the ones offered for mortgage tax deductions. So in the end, the choices are similar to the previous examples. If you're an active investor, it would make more sense to invest to earn those higher returns and continue to pay your loans. But if you're not investing, focusing on paying off your student loan debt and having that peace of mind may be worth it. Okay, the final topic is credit cards, and I think you can already predict what I'm gonna say here. You may not think of credit cards as loans per se, but they very much are, and the interest rates they carry is by far the highest of anything I've listed thus far. Credit cards represent toxic debt that has zero benefits, aside from perhaps building your credit as you pay it off, and pay it off you should as fast as you possibly can. Credit cards should always be number one on your list of debts to pay off, as the interest they charge is far higher than anything you could earn on any legit investment, and interest rate arbitrage is not really possible here. Okay, that wraps up a quick tour of the various types of loans and debts that people carry, and hopefully this video got you thinking whether paying off some of these is or is not a good idea. If you enjoyed this video and found it useful, please do subscribe to the channel and hit that notification bell so you don't miss any future finance and investing videos just like this one. Thanks for watching, and I'll see you guys soon.